morning, everyone. Thank you, Victoria. Happy New Year. It's been quite a year that we've been at, but thanks to Mark and George for having me. Thanks for coming along today. So let's get started because there's a lot to cover. And the title is, What Do I Do Now? Is what am I going to do? And this is a quote from a customer of ours who texted me after one of the big reports last fall and goes, what am I going to do now? I debate whether to say this up front, but let's just kind of get it off the table and say, there are no silver bullets, and I don't have any silver bullets in my pocket or in this presentation. So let's get off the table and let's start about where are we today and what do we look for as we go forward. This is Millian Bakey's news, and I thought it was a very apt cover. There's a cloud of dust. It's a little gray, it's a little hazy, and you can see all the people involved in that dust and what it's going to do. And I think that's a good where to start is, unfortunately, we're all in a cloud of dust. Our crystal balls have kind of a little crack in them. They're a little bit cloudy, and what do we do from here? And unfortunately, when you look at the macroeconomics, what I'll talk about, it's on this hand good, and on the other hand, it's like, ooh, that's not so good. When you look at agriculture, it's a bit of the same thing. So we'll talk about that this morning and get going. So let's dive right in and talk a little bit about where we are in agriculture. I've shown this to you before, and it's a good place for me to start and talk about some different things. As you can see, I would tell you now that we're in the bottom of this trough. Doesn't mean we're coming out of the trough anytime soon, and you can see we still have question marks on there about where that's going to come out. We do think that by 27 we could see this kind of pick up and everything look a little better than it looks today. But we're at a situation now where farmers have exhausted most of their working capital. They've exhausted most of their, any rainy day fund they might have in place. And so now it's what do we do to finance that? And how do we keep our operation moving forward? The big challenge though too is when you look at all these pieces up the right-hand side of that chart, none of those prices have come down. There may be a glimmer of hope on fertilizer, and I'll show you that in a minute, but the fact is we're still in a very serious situation and a very concerning situation for us as a whole. This is what's really concerning is that typically what you see over time in a trough like we're now, you see a convergence of commodity prices and a convergence of costs together. And you can see that is exactly the opposite of what's happening now. Costs continue to climb, and we continue to see commodity prices, and I'm going to argue to you a little bit later, are at a point now where we're at sort of a bottom. Is that there's not a lot of downside here. There's some, not a lot of upside either, but the fact is those costs keep going up, and we're diverging, not converging. And that's a big concern for us as a research group. It's a big concern for me personally. Here's the fertilizer. I know this is going to be really hard to see, so focus on the big one. You see the individual NPK on the left-hand side. But what you see is we look at affordability index, and it's calculated by looking at both the cost of fertilizer and also the commodity. And you can see that it has been in a downward spiral. So anything below zero means it's unaffordable or not very affordable. Anything above zero means it's much more affordable based on the commodity prices you can see. You can see we've been on a long-term slope here over the last several months. It has started to tick back up a little bit, partly because you've seen commodity prices come up a little bit last fall. That's the good news. So that's the ray of hope we have to think is that maybe we're going to see fertilizer prices as we get into this. As farmers cut back, we start to see some affordability in fertilizer going forward because there's just not the demand there. We have to talk about the government. Excuse me. So this is hard to see, but I want to talk about this. You can see there's two big bars there, and the yellow is ad hoc payments. Those are in 2020 and in 2025. I'll concede to you that in 25, which is $42 billion is coming in agriculture, may not exactly reach that level when it's all said and done, but the fact is the government has pumped in a tremendous amount of cash into the agriculture sector. We have a lot of concerns about that for lots of reasons. Yes, from a banker's perspective, we like to see that cash on the balance sheet. It does help bring balance sheets back, and we saw that back in 19 and 20. On the other hand, though, our concern is, and remember the slide previously that talked about fertilizer prices and what we've seen on prices, all this cash coming in just continues to it's the old inflation thing. You've got more cash than demand. And so you continue to inflate asset cost or asset assets like land. You also continue to see that capitalized into chemicals and seed costs and all things like that. So this cash does have a price that we all pay for that. And so we need to be careful. And also you may start to see a pushback from folks other than agriculture saying, well, wait a minute, I'm a small business on Main Street and I've really struggled by these tariffs. Why am I not getting money? So it's just a warning, I guess, and a little bit of an insight of what we're talking about with our bankers and with our risk people, and also with our clients about what's happening in the sector. But it's really, this is a huge amount of money coming in the sector that's going to help put balance sheets back in a little better spot. Here's just so if you haven't seen it, here's the payouts. The South won again. No disrespect to the South, but cotton and rice got a big amount of money per acre. And you can see when you start to think about specialty crops, this is the $11 billion. There's still $1 billion left for specialty crops, and there's just not going to be enough. They're not going to get what they likely deserve in the sense of they've had the same challenges as row crop farmers, or what you would call row crop farmers. So let's talk about tariffs a little bit. So this is looking at the trade weighted average is a little bit over 11% right now. Now we have a lot going on tariffs, and people are anxious waiting for the Supreme Court to say, is the IEEPA, was that a wrong legal standing to do all these tariffs? I will warn you, or at least be cautious, is that even though, let's say the Supreme Court comes out and strikes us down and we see tariffs come down, that would be a good thing for all of us from an inflationary standpoint of view. The administration already has at least two other legal footings that they're going to use to maintain the tariffs that they've put in place right now. So just be aware that even though the court may strike it down, that will not be the end of the story. Okay, let's get a look at the macroeconomics. So here's the global GDP, and you can see there's a lot of lines there, but we want to at least look at where it's kind of the trend. And you can see that we had a big increase in GDP around the globe after COVID because there was all that pent-up demand. And now we've been in a slow slide down. Now, one thing I will tell you though, so this is the October IMF numbers. They did uptick, or they did bring their GDP forecast up a little bit in their October numbers, but I'm talking, 0.2% type numbers. So you can see a very flat global economy going forward, which is not necessarily great for us as agriculture because we need that GDP to go up. But the fact is, it is still positive. That is the good news. And so there will still be positive demand for our products. Here's the U.S. The good news is we looked at the third quarter and had a 4.3% annual rate of GDP. So very, very strong GDP in the third quarter. The question is, how long can we maintain that? It takes a while for declining interest rates, tariffs, all the things that are happening to filter through the economy to come forward. But you can see we're going to have a lot of bumps as we go forward. We're going to have one good quarter, then we'll have one bad quarter. And also, as I note on the slide, we did see a very odd dilemma where we saw a huge increase in exports, but then we saw a huge increase in exports, which has something to do with the dollar, but also then a very strong decrease in imports. And so you got a little bit of that. That does have a big impact on GDP. So let's not get overly exuberant, as Chairman Greenspan would said, over a 4.3, but let's be aware that we could see a lot of volatility here. Fed funds rates coming down, not a big surprise there, but I do want to show you the infamous dot plot. So you know that the Fed has had a lot of dissension or a lot of discussion, not a lot of consensus in the last two meetings that they've had. And you can see from the dot plot, and you look at that, is that second set there. Specifically, they're thinking probably maybe another 50 to 75 basis points decline as we go into 26. But you can see there's a pretty wide spread about everyone's saying, well, it's going to be the same. We're going to take 25 points. There's another group at 50, then a 0.75. So there's going to be a lot of things. I think you'll see a lot of volatility within the Fed over the next year because we are going to get a new chairman. The president will have to appoint this year because Chairman Powell's term runs out. The other thing I would say is don't read a lot there's a lot going on there, and the data that we're seeing is a little bit tough right now because we have the government shutdown and we're trying to get caught up. And so when you look at GDP numbers, you look at labor numbers, you look at interest rates, you're going to see some revisions. That always has happened. That's nothing new. But keep in mind, because of the data challenges we've had over the last, I guess it would be 4 months now, that don't get too caught up if you see revisions coming on. You'd like to see the revisions so we get it right. But you can see we're going to have a lot of variation. The bank is officially saying 3 down, 3 25-point cuts in 2026. We'll see. I think it depends a lot on how the economy comes and what we see, because the economy is showing signs of both, of good and bad. So here's the dollar. Now this is the index, and you can see the dollar has come down quite a bit from early last year, but at the same time, you know, we've now kind of plateaued out a little bit. But with the cheap dollar, it's cheap because the interest rates are coming down and people are not investing in it, that creates another problem for us. And you can see that while it has increased exports, it has also hurt us from the standpoint of investment in the United States. And you're going to have to be able to finance the debt. You're going to have to keep interest rates high to attract dollars to help finance the debt. Here you see some of our partners, and you can see it's a little bit all over the board, but generally you can see, other than Japan, that other currencies have strengthened against the dollar. And so they have a lot more buying power than we have because they have a stronger currency around the globe, which has also helped our exports. So, you know, it is a yin and yang across all of these macroeconomic views. So let's talk about inflation. So the good news, it's down, and you can see that it's been hovering around 3%. You can see that the Fed's preferred PCE on the right-hand side is still sort of hovering a little bit above that 3% number, and the Fed, you know, a lot closer to 3%, is not having much downside. The Fed would like to see it come down to 2% as their goal. There is some argument, and I think Canada maybe have the right solution, is that maybe we should put a 1% range around that perfect thing so that if we're in that range, that's a good thing. And so there are some arguments within the Federal Reserve, there's some arguments from some economists that we should get to a point where maybe we look at this a little broader rather than to pinpoint a number, say it has to be at 2% or less for us to be good. But here's what the consumer is experiencing. It's been a 27% increase in the CPI since May of 2020, right after, you know, once COVID started. That's what the consumer is experiencing. And I can stand here, or anyone can say, well, you know, the economy's, you know, we're still growing, you know, unemployment is still pretty good, but this is what the consumer is responding to and saying, I've got to make a change because I can't afford this anymore. The other caution that I'm worried about here is the PPI. Sometimes it doesn't get a lot of attention, but you can see the PPI has bottomed out and has now been coming back up here in 25. You know, so that's all the wholesale goods that are bought to make the retail goods. And so if that's going up, that's going to flow into us at some point, and the consumer's going to feel some of that, some additional pain. Now, granted, having said that, you know, retailers are feeling that pain as well and are going, Mr. Supplier, I can't take any more, or Mrs. Supplier, I can't take any more. But the fact is, that will eventually will pass on to the consumer down the road, because where's that money going, you know, how are we going to pay for, whether it's transportation, packaging cost, raw materials, tariffs, whatever that's coming in, it's going to be a real challenge. So when we look, I looked at some things and thought, well, this is interesting. So when you look at the money supply, you can see it continues to grow quite a bit. And so you think, if you have more money supply, that does sometimes mean a little more inflation, but it does mean there's more money in the economy, people are saving, people are making investments, all that sort of thing. And so that can somewhat be a temper, because you have all that money in the system to temper inflation. But when you look at the velocity of it, that gets a lot more concerning. The velocity means that dollar is turning over more in the economy, it's being spent, and it's going through. And you can see that velocity has started to move back up. And so it's one of those things I'm watching and saying, okay, it's come back up, but it's flattened off, so maybe it's not as inflationary. But when you look at that money supply, you go, oh boy, I see all that money coming in the economy. So again, a yin and a yang about, yep, this looks good, but this doesn't. So something to be paying attention to, all these conflicting signals in the economy we have to deal with. The good news is that despite what you're hearing, when you look at the numbers, the hourly wage is still, the percent raise in that is greater than what the inflation rate is. It's come down, and so now, but it is narrowing. And we have seen as businesses have started to, that employment rate has not ticked up because there hasn't been less people participating in the labor economy. And I'll come to that in a minute. But so you do see consumers still having a little bit more money in their pocket because their wages continue to show some increase. Oops, wrong way. Oop, there we go. So as I said, unemployment's still okay. It's ticking up a little bit, and that's the other part of what the Fed is thinking about now. They see inflation coming down, but they see employment going up, and I'll show you some other things that are a little more troubling, is the labor market's getting a little weaker, and that's what's causing the problem. Here's the job generation over since COVID, and you can see there's been a pretty steady decline in the number of jobs generated per month. There will be revisions here, so be cautious of that. But you can see it's been a lot more uneven now. We'll go 1 month where we don't generate jobs. Part of that's been government. I'll show you another part of that's been manufacturing. And then the next month you come back and go, it's come back up because they've revised it or those people have found jobs. But you can see it's a mixed picture, and this is what the Fed's looking at and thinking, oh boy, I don't know what to do with this because I need to make sure that we continue to keep people employed. And when you look at labor numbers and you talk to labor economists, labor and employment is one of the most important things that people, from an economic standpoint, watch because it helps us understand what is coming in the economy next. You see job losses, that doesn't pose well for spending, which is 75 to 80% of our GDP. So here's manufacturing. This has been the big push, of course. Let's make sure we have more manufacturing jobs. And you can see on the left-hand side that they've now peaked and they've started to come down. And then you look at the changes on the right-hand side, you can see now that's a stable decline in manufacturing jobs from a month-to-month sort of thing. As I said before, people losing jobs, that's not a good thing. And manufacturing has been one of the key points that administrations have tried to bring manufacturing back to the United States, increase manufacturing internal, and we're not seeing results from that yet. There's the job market. There's still more jobs available than people seeking jobs, but you can see that is narrowing very, very quickly. And if those lines cross, then we have a real problem, Houston. And so that would be, again, as I said, what we're watching is those employment numbers, what happens to employment and what happens to the consumer that way. The good news, real disposable income is still going up. We all have more money in our pocket for the most part. Agriculture might be one of the exceptions to that. But you can see the rate of growth has really slowed down. And so the consumer is starting to think about that in their spending. And that's why you see GDP numbers starting to come, kind of slow down just a little bit. Also, same thing with personal savings. Personal savings has come down dramatically. And in some senses now you see consumers dipping into that saving either to pay the monthly bills or to buy buy the food or buy, shelter or insurance or whatever the case might be. But look at consumer debt, continues to go up. And here's why that's really interesting. So the blue line here is consumer debt. It's the same line I just showed you a minute ago. The green line here is what economists call the real credit. So you're basically deflating it for the inflation. And you can see that debt is basically flat. Inflation is helping the consumer continue to spend some money and not feel that pain in some ways. And then when you look at the orange line is looking at their income. And when you look at the ratio of debt to income, it's relatively flat, in some ways going down a little bit. So the consumer, consciously or unconsciously, is reacting to that and going, from an inflation standpoint, if I buy it now, it'll be cheaper than later. My debt, my income is going up, and I'm thinking, as a percent of my income, my debt's not that heavy. And so they're reacting to that, again, consciously or unconsciously. So you have this conundrum of increasing debt, but when you look at it, kind of dig into the numbers, it's sort of benign, as I say here. But this is the breakout by income percentile. And you can see the green line is the upper percentile and how much their spending has gone up because they have the money. And you look at this and go, okay, this fits the K economy and what everyone's been saying, that the upper echelon. The interesting thing about this, I dove into this and said, okay, let's look at this from a compound annual growth rate. Then also looks like just the percentage increases. Surprisingly, they're about the same for all quartiles. Now, yes, there's part of the math there, but you go that and look at that and go, how could that be? And I don't know that I have an answer for that yet. But the reality is people can, that their spending continues to grow even with their income at the same rate, no matter what the income level is. But here's the click here. Like I said before, here's consumer confidence, University of Michigan survey, well respected. It's at all-time low levels. And until the consumer feels comfortable, they're going to stay at these levels because they just don't know. And it doesn't, it's a whole host of things. Could be medical bills or medical costs, their food bill. Think about where you're going to buy food today. You've probably changed some habits if you're able to do that. So the consumer is very, very, very concerned right now and doesn't feel good. So with that, we're going to move into global fundamentals on the crops and show a little bit where there are maybe some, what should we say, I guess in wheat country you see that dormant wheat come up over the snow, maybe there's a little bit in there. I'm going to skip this, but I want to go to this first. So this is grains and oilseeds, so I remember that, but it does apply as you think about your potato business as well. In 25, everybody in the world planted a crop, and everybody hit on 8 cylinders, and we had more than we've ever had before. We don't have a demand problem, we have a supply problem. That's true in potatoes as well. And how farmers react to this is going to be very interesting in 26. Do we cut acreage back? We've already cut principal crop acres in the United States about 8 to 9 million acres. If you look back to 1420, that number, we got all said and done, was closer to 11 million acres. So I would argue there's a few more acres that need to be cut so we can get the supply and demand and get the balance sheet back into balance so that we're not in this situation we are with overproduction and overstocks. Here's the global stocks in the bars. You've seen some of this before. But look at that black line. This is the surprising side, and where that little piece of green wheat coming through the snow is maybe optimistic. We're not, despite the supply situation, supply is not keeping up with overall demand, and that's what that stocks-to-use ratio is telling you. And there's some crops this is more critical than others. Here's the overall crops, or stocks-to-use ratio for each crop. And you can see they're okay. They're up in the upper echelon. The green bar is corn. And so coming from Iowa, corn is king. Corn drives a lot of commodity prices like crude oil prices do. And you can see that corn continues to be in a multi-year decline stocks-to-use ratio. So if there is any sort of hiccup in corn, and keep in mind there's 2 major producers and exporters in the world, the US and Brazil, any hiccups here or down there, that corn situation gets a lot tighter, a lot faster, and you see prices react accordingly. You get a lot more volatility in these markets, and I'll come back to that in a minute, why that's happening. If you look at the overall stocks of the exporters, they're in pretty good shape. They're in best shape they've been for quite some time. So this is all 4 major crops around the globe. In the case of rice, and in the case of what I would say soybeans, also in a very big glut around the globe we need to get rid of. So here's the overall. So what I just showed you was the exporters. The bottom bar is the exporters. The upper bar is the rest of the world. And again, you can see for all the crops, we are well supplied. As I said, this is a supply problem, not a demand problem. I'm going to skip over China a little bit, but here's the stocks-to-use ratios for the exporters. Look at where corn is, the green bar at the bottom. It is near the bottom of its all-time range. And that is, over history, if there, again, you see the volatility because the exporters are not holding much supply or have a very small stocks-to-use ratio, any hiccup gets magnified and we see a lot more volatility in the prices going forward. And that will ripple through corn, soybeans, every commodity we can think of. You can see, I think it's rice is very large. Soybeans and wheat are kind of sort of not a big concern right now. But that corn number is one we're watching very carefully and see how it goes in the next couple of years. Here's the other little green sprout. Consumption is good. It is strong. It continues to grow. And as long as that's the case, that is a good thing for all of us, that we'll continue to see that underpinning, if you have it, which is why I don't have a lot of downside view on where markets could go, because you have this huge foundation of demand around the globe. That's true here. and particularly at lower prices, you have that good demand around here and around the globe that will keep prices from falling through the floor because people continue to need to buy it. So, and you can see, and I've looked back, I think I've said this before, there are 5 times since 1960-61 that we've seen a year-over-year decline in growth in domestic demand. And 4 of those have been recently, and they've all been under 1%. So keep in mind that demand is still there. Here's the GDP versus that demand, and you can see because that GDP continues to climb, we're going to continue to see a growth in that chart I just showed you. They're highly correlated. It's about a 96, 97% correlation. If you start to do the regression, it's similar to that as well. So it's a very good indicator, a very highly explanatory variable to see demand continue to grow. And at this point, GDP continues to grow globally. I just want to say one thing about this. This is the Rabobank trade map. We do this about every 4 to 5 years, and we've done now 5 of these since the early 2000s. And it's, you know, you can see the 2 big dogs, Brazil and the United States, going into Asia. But this is the interesting thing, and I know there's a lot of words here, and I'll paraphrase this for you very quickly. But one of the things that's interesting to us is that, you know, we sit here day to day and we look in our backyard and think, well, nothing's really changed. The reality is a lot has changed. When we started this, the U.S. was the #1 exporter of corn, wheat, and soybeans, and was also at rice at that point as well. And now that is not the case 25 years later. You know, we're still #1 in corn, we're number 2 in soybeans, Brazil's #1, and Russia's #1 in wheat. And also you look at the import side. Europe was the big importer at that point. They're not the big importer anymore, although I will tell you, Europe is likely to have to import more from us because of their climate change regulations. So I look at this a little bit like glass half full, not empty, full, is that when we look at it and think, boy, it's never going to change, it does change. And as we go forward, keep that in mind. There are going to be opportunities that we maybe can't see right now because our backyard it's pretty foggy. Here's our row crops. We don't see a lot of change in acres as we go forward. This is from our 10-year baseline. A lot of questions about what soybeans will do this year. Will soybeans come up this year? We think they have to, and that's a really horrible thing to say, have to. But, you know, when you look at, again, another yin and yang sort of thing. When you look at soybeans, the returns have not been very good. But when you look at a rotation, and when you look at that crop corn soybean rotation, that's been the most profitable thing for farmers to be in. And soybeans have gotten really down this year, but we had good yields last year. So farmers will look at that and go, I need to plant some soybeans because that's good for me in the long term. You look at demand here in the U.S., still pretty good. Low prices help that, but we continue to see pretty good demand. You can see exports are a little more variable than we've had in the past. They've moved up, which is the good news, but we see a lot more volatility from year to year, and that certainly hasn't been helped by the tariff situation. There we see, when we look at exports for soybeans and wheat, pretty flat. Corn, we see opportunities there, and part of that is because what's happening in Brazil. Their corn crop is growing, but also is their domestic demand for corn ethanol. And with that being the case, they have less to export, and we have a better opportunity to do that. So that's why we are optimistic about corn exports going forward around the globe. Here's the half glass, half empty. Here's exports of corn, wheat, and soybeans in the bars. The top black line is our share. It's about 24% today versus almost 75% not too many years ago. But the really thing that's even a little more troubling is the bottom black line is our volume. It's kind of what I just showed you a minute ago. And you can see it's been relatively flat. We're not growing markets. And if I could be a little preach for a moment, what we really need, and I think you all understand this, is we need market access. We need to make sure that the ability for us to ship as U.S. farmers into other countries is critical. And so we have to make sure we get that market access. That's what we need to keep moving forward as exporters. And they're flashing the light and they warned me there's a hook someplace will come out and take me away. So I need to finish up here pretty quickly. But I just want to show you this. This is U.S. soybean exports to China. And you can see they were on a nice trajectory. up until 2018, and now we've come down a lot, and we're moving around quite a bit as we go forward. China is expected, just on just one thing to say, China has taken about 8 million metric tons of soybeans here in the last month or so. They're supposed to have 12 million metric tons by the end of the year, then 25 million metric tons by the next 3 years, or 25 million tons each of the next 3 years. Now, I want to caution that. The good news is they're taking soybeans again, and there is an agreement to do that. However, be wary, because that agreement announcement came from the US, it did not come from China. And China has never whispered a word about that. And for those of you who've had dealings with China, you know they are very, very good negotiators. And you know that they can be very challenging to negotiate with, and they don't always hold their promises. So I guess, to use the Ronald Reagan trust but verify, we need to verify that, and the Chinese have not done that yet. So I just want to throw that little caution out there. But the good news is they're taking some. Maybe they'll start to take some more things as we go forward. I'm going to end on this slide talking about pricing. So this is corn, wheat, and soybeans all on the same slide. This is a weekly, so you can kind of see they move together. Not a big surprise to anyone in this room. We don't think that's going to change too much. When you think about, we started back in the fall of 24 in this trading range that we've been in ever since. There's been a lot of volatility in that range, and we expect that will be continue to be the case in 26. 26 is going to look a lot like 25. When you have opportunities, reward the rallies. For those of you who are buyers in the room who might have livestock, when you get a downdraft, that's your opportunity to pull in. It doesn't appear there's going to be anything in what we see in our foggy, cracked crystal ball that's going to change us anytime soon. So reward those rallies. When you have the opportunity and you can get it, do it, and move on, and not worry about, it's like the soybean rally we saw this fall, anticipating this. We heard people go, "Oh, beans in the teens now." And I just cried, and I said, you've had almost $1.50 rally in soybeans, reward it. And that's, if I leave you with that, reward the rallies. If you're a buyer, reward the dips, and move on, and not worry about what potentially could happen. We're not saying you sell the whole farm, but reward the rally and move on and go there. So the hook's going to come. This is the lawyers telling me I'm an idiot. And here's my contact information. So thank you very much. Thanks for coming.